Hey, welcome to the Mortgage Minute for December 15th. 10 days before Christmas. Hard to believe, isn't it? But that's a whole other topic. Today what we're going to talk about is the big news, the comments that Mark Carney's having, the Bank of Canada, and Ottawa getting in the mix with Jim Flaherty, even Prime Minister Harper saying we encourage Canadians to manage their affairs soundly. So lots of interesting news. The most important thing we want to focus on is the language you're hearing from the Bank of Canada. I mean, I haven't heard this language ever. I mean, he says we could be in for a brutal reckoning if Canadian homeowners are not prepared for higher interest rates. Also went on to say that our complacency is an issue and that the risk reversals when they happen can be fierce and high interest rates. Well, this, needless to say, this has caused a lot of people concern in the markets. And then you have Ottawa coming out with a debt alert, was a big headline, and Ottawa suggesting that they may have to lower the amortization again, increase the minimum down payment. And of course, you know, this is all going to get people concerned and worried in the marketplace. So I want to put some perspective on this. First of all, clearly the Bank of Canada is concerned, and Ottawa is concerned about the fact that we've had historically low rates for so long that now you start to wonder, are Canadians really being responsible with the debt they're taking on? And here's where it really comes down to. We need to understand as consumers that this is a grace period of low interest rates. This is not a norm. And there's two components to this. Number one, don't start spending recklessly because you have low interest rates, assuming that you have low interest rates forever, because rates are going to go up. But here's the flip side. We also can't get so concerned about that we start worrying that rates are going to skyrocket. You know, when he says there's going to be a brutal reckoning and reversals could be fierce, I don't know. Is this saber rattling by Mark Carney, or is he really suggesting that we're going to have a huge interest rate creep? Now, let's think about this. I don't think it's possible for him or Bank of Canada to have a significant raise in rates simply because Ben Bernanke and the feds down the States are not doing the same thing. And there's only so much gap between what the Bank of Canada can do and the feds can do. So if the Bank of Canada starts moving away and that gap widens, there's going to be pressure for the Bank of Canada to lower rates. In addition to this, we've talked about before the Canadian dollar. The pressure on the Canadian dollar is going to be upward, and you're eventually going to see that upward pressure cause the Bank of Canada to have downward pressure on the lowering the interest rate. So again, a high Canadian dollar will equate to low interest rates, and we're bound to see that with the quantitative easing in the States is going to create a higher Canadian dollar in Canada. Therefore, all these factors outside of Canadians' consumer debt is going to put downward pressure on rates. But Mark Carney's trying to send a clear message to Canadians to get your debt in line. We have historically low rates. I talked about this last time on the Mortgage Minute. You have 1 year of relatively historically low rates. So my challenge to everyone out there is heed the advice Mark Carney's saying, but how are you going to manage your debt? Don't get over leveraged because higher rates are coming. A, don't get over leveraged. B, if you have an opportunity to reduce debt, do that as much as possible. For more information on that, go to my website, peterkinch.com. I've got articles on this stuff. And, you know, again, keep perspective. Don't let the headlines freak you out and lose perspective. And more importantly, make sure the partners you're talking to are getting advice from you, not from the headlines. Thanks. That's the Mortgage Minute. Have a Merry Christmas.